What we have seen during the first quarter of 2016 is tremendous volatility in the markets caused by fears of a global recession emanating especially out of China. As we look into the second quarter of 2016, we are actually seeing a stabilization of fears over a global recession. The US is still growing slowly. Europe is actually performing still better than many people expected. And importantly, we're now seeing the convergence of policy in China, both monetarily and fiscally, to create the new story for China into the second half of this year. Therefore, we believe that we don't need new sources of economic growth at this time because the existing engines are still working fine and the markets have been more nervous than they should have been as we entered 2016. As we look into the themes for the second quarter, we think there are two dominant themes. The first is still the ongoing debate about monetary policy around the world. In Europe and Japan, we have the negative interest rate policy, which has not been well received by many parts of the investment community and certainly has not created the moves in the currency markets that many had anticipated, with both the yen and the euro strengthening during this period of negative interest rates rather than weakening further. However, we know that many of the central banks remain data dependent, and therefore if the economy is slow, we can expect to see less monetary interest rate rises, particularly in the US, and if the economies are strong, we can see interest rate rises and less quantitative easing on the table. The second theme, particularly for Europe, is going to be the referendum in the UK on June the 23rd. This is a very, very important debate, but importantly, as we look at the world, we think it's a debate for Europe, not just the UK. Whilst the UK will be doing the voting, we think that many parts of Europe will be concerned that if Britain chooses to leave, it will have negative consequences for the confidence in the journey to the United States of Europe that we have been talking about, and therefore will create a level of tension around the euro and euro assets in general, both equities and bonds. We believe that the challenge for investors globally remains the same as we looked into 2016 with our outlook statements. Volatility is here. Volatility is being caused by disruptive emergencies inside many industries, but also because of politics and also because of the geopolitics around the oil price. Therefore, we think clients have two choices. They can look to take a long-term capital appreciation style of investment, or they can stay more opportunistically towards income investing, both in fixed income, credit and equities. We believe that our clients need to be active with their investments at this moment in time in the markets. They need to be confident in their long-term assessment of the assets and the investments that are going to generate the returns that their clients require. But they also need to be agile so that they can opportunistically take advantage of the volatility we are now seeing in global markets rather than being buffeted and whipsawed by them. And we also think that they need to be thorough in terms of their assessment of the resources that their fund manager has at their disposal, and in terms of the investment process that fund manager is deploying, so that they have confidence that they will be able to meet the alpha returns that their clients need, given that beta returns are going to remain low and volatile.